Hi there and welcome to the Stockscores Market Minutes for February 28th, 2014. Today I'm going to talk about bang for your buck, but before I get into that topic, I want to let you know that I will be doing some Stockscores introductory events in Calgary and Vancouver in the month of April. As well, for anyone that has attended one of my classes in the past, any of the Stockscores trader training classes, if you have been a past student, then you can participate in one of the refresher events that I will be doing in Calgary and Vancouver. Now, for those not in the Calgary and Vancouver area, we will also be doing some web-based versions of these presentations, and stay tuned for details on that. If you would like to register for one of these events, go to stockscores.com, go into the upcoming events area, and that is where you'll see registration details. All right, let's get into this week's topic, which is bang for your buck. We based our position size, how much of a stock we buy, ultimately on the price volatility of the stock, the difference between the entry price and the stop loss price. So if we're buying a stock at $10 and we have a $9 stop, then we have a $1 a share amount of risk. And if we don't want to risk more than $500, we would buy 500 shares. Now, if the stock was less volatile and the difference between the stop loss price and the entry price was only 50 cents, well then we would buy 1,000 shares. I hope you get what I'm trying to put down here. The price volatility determines how big a position we take. And of course, the more volatile the stock is, the smaller the position size. Now, while position size may be smaller for this volatile stock, the potential gain is the same, since the expected volatility in the future will be higher also. That stock that trades with a lot more volatility and therefore has a wider spread between the entry price and the stop loss price should also be more volatile in the future. So we tend to see that volatile stocks, we can just take smaller positions in them. Now you can play the exact same strategy on a low volatility stock versus a high volatility stock, but get a much higher percentage return on the high volatility stock. And this will make a little more sense when I show some examples in just a moment. Higher price stocks tend to have lower volatility than low price stocks. So the trader who has less capital to work with will tend to gravitate towards lower price stocks because they have better potential return for the money. And that's where we get into this bang for the buck concept. All right, so let's look at a couple stocks from the last week that met the criteria of my simple swing strategy. The entry point on this particular stock, HPJ, was at the blue arrow. My entry price, 311, stop loss at 298. That left me with 13 cents a share in risk. Now, if I don't want to risk more than $500, well, then I divide $500 by 13 cents a share to come up with a position size of 3,800 shares. And of course, 3,800 shares times $3.11 means a total position size of $11,818. Now again, that's for this particular stock, which has a difference between the stop loss and the entry price of 13 cents, which on a $3 stock is noteworthy. Now if we go to the next example, another stock that met my simple swing strategy last week, which is Kimiko, it had an entry price and a difference between the entry price and the stop loss of 28 cents a share. However, 28 cents a share is on a stock that's trading at $21.65. So as a percentage basis, that risk per share as a percentage of share price is much lower. And that's because Kimiko is a much less volatile stock in percentage terms. So here we've got a situation where the risk per share is 28 cents. And if we want to take that same $500 of risk, 1,750 shares is how many we will buy. Well, that leaves us with a total position of 37,887. That's 3.5 times what the position was on HPJ. We're taking the same amount of risk. If these trades don't work, either one is going to lose us $500. And both of these trades worked out great. They both made, more than $4,000 in terms of profit. But the difference was that the first position, HPJ, only took $11,800 of capital to make the trade, while Kimiko, for the same amount of potential profit, required $37,800 of capital. So the point is pretty simple. The lower price stocks will tend to give you more bang for your dollar. The problem is that there tends to also be less liquidity in the lower price stocks, and so taking really large positions in some of these cheap stocks gets a little bit more difficult. You can get more slippage. Anyway, keep that in mind when you are trying to evaluate what stocks are right for you and your portfolio size. The S&P 500 remains in a bullish trend. It had been sort of spent a week last week under resistance, and this week it's tickling through that resistance. It didn't do so in a real resounding way, but at the same time, the rising bottoms are still in place. You see that here on the weekly chart. And we're not at the top of the channel, so I think that this market is likely to continue higher. With the things going on in the Ukraine, we may get a little bit of a rocky start next week. I don't think it matters a whole lot to the U.S. stock market, but sometimes these things cause investors to be a bit nervous. In the short term, we could expect that, but ultimately, the market is in a long-term upward trend, remains so, and so we should remain bullish. Bullish is what we also see in the Canadian market, which has rising bottoms. The difference here is that the Canadian market hasn't broken through that resistance, and this is pretty long-standing resistance going back to 2011. So my expectation is because we've had a pretty good run in the last 4 weeks in the general Canadian market, we may see a bit of a stall here, maybe even a little bit of a pullback. But it's important to differentiate the TSX, which is made up of the largest 60 companies in Canada, with the TSX Venture market, which has been doing surprisingly well in the last few weeks. Now you can see that this market has been absolutely dismal for a number of years. The long-term downward trend was recently broken, and we're now starting to build optimism. And I think this is the place that the traders who look for those cheaper stocks where you get that better bang for your buck want to again focus on. I've been featuring quite a few of these junior Canadian stocks in my trade alerts at tradescores.com, and it's simply because that's where the action is again. There hasn't been action in this market for years, and it is nice to see that that is picking up again because some of the easiest money in the market can be made in these stocks. They often don't have a lot of great fundamentals, but they do move well when there is optimism in that market, and we do see that optimism building. The Treasury market had a little bit of a rally last week, and I think it's likely to continue to move higher until it hits resistance at that red downward trend line. So my expectation for U.S. Treasuries is higher prices, which means lower interest rates. U.S. dollar fell off in the last week. It is now at some important support, which it needs to hold, or we're going to see further weakness in the U.S. dollar. Given that the overwhelming mood around the U.S. dollar is pessimistic, you can see consistently falling tops on the U.S. dollar. That tells me that not a great outlook for the U.S. dollar, which isn't a bad thing. A lower U.S. dollar actually helps commodities and helps stock prices as well. I'm pulling up here a very long-term chart of gold. One of my students and members of Stockscores.com highlighted this for me. She showed me that the monthly chart of gold going back into 2005 has this very long-term upward trend line, which is exactly where the gold market has bounced. And this month, the gold market has broken its downward trend line. And that tells me that gold should be stable here and should move higher from here. And that's probably one of the reasons we're seeing strength in those junior Canadian stocks, since many of them are mining names. Oil is in a long-term pennant pattern, basically sideways trading. We're approaching the top of the pennant, so we should see that upward momentum of the last couple of months start to slow. But I don't think there's considerable downside, don't see considerable upside. I would call this market simply neutral. Fear had a real jump up at the end of January there. It has fallen back again. It is interesting to note that the VXX is not going to new lows while the S&P 500 is going to new highs. And so that tells me that there is a little bit of caution in the market as stocks move to new highs. There are still some people buying insurance in the option market, which shows up in that higher prices in the VIX. So bullish on U.S. stocks, short-term neutral. I just feel like we still have some potential for some profit taking in the near term, but general outlook is still bullish. Canadian stocks bullish. As we hit that long-term resistance, we could see the market stall in the near term. Gold, bullish, but looks to me like, if you look at the daily chart of gold, it looks like we're going to see a little bit of profit taking in the near term, not a bad thing. And oil neutral on both time frames. U.S. stocks are trying to break through resistance at all-time highs with tech and basically the NASDAQ leading the way to new highs while the Dow lags. The Canadian market is coming into long-term resistance, which should slow the large cap advance, but the juniors in Canada are showing good promise. Gold will likely see short-term profit taking in the near term, but the longer-term outlook is good, and oil is neutral. Well, that has been the Stockscores Market Minutes. A reminder to register for some of those upcoming events that are on the upcoming events page at stockscores.com. But in the meantime, and for next week, trade well.